Well, good evening, everyone, and thank you for joining us for tonight's program, Navigating Financial Literacy for Families and Individuals with Autism. My name is Siobhán Alvarez, and I am the Executive Director of the Atlanta Autism Consortium. If this is your first time joining one of our programs, welcome. We are a nonprofit organization dedicated to creating collaborative connections throughout the Metro Atlanta autism community. We host free programs and events every month, just like this, and aim to serve the spectrum at large, including parents and family members, educators, adults with autism, researchers, clinicians, and educators. Before we get started, a few quick housekeeping notes. Please know that your microphone will remain muted, but you can feel free to ask any questions throughout the event by tapping them into the chat box, which is located at the bottom of your screen. After the presentation, we will have a Q&A session to wrap up the night with our panel. You will also receive an email with access to all the presentations and materials that are being shared tonight, as well as the contact information for all of our panelists after the webinar ends. This evening, we are joined by Falita Flowers of Greater Atlanta Builds Credit, D'Andrea Austin of Greater Atlanta Builds Credit, and Scott Jefferies of Northwestern Mutual. Falita, would you like to take things from here?
Yes, good afternoon or evening. Thank you so much, Siobhán, for having us join you and your group this evening to discuss financial education and how to achieve financial empowerment. Just really quickly to review the agenda. Thank you again, Siobhán, for welcoming us. I wanted to take a few minutes, 1 or 2 minutes, just to provide an overview of Greater Atlanta Builds Credit, and then we'll move right into the presentation starting first with Ms. D'Andrea Austin, who will provide us some information regarding basic money management strategies, as well as speak more about financial coaching and financial planning and how both can assist with achieving financial goals. And then towards the end of our time today, Mr. Scott Jefferies will speak with you regarding financial planning and how to use financial planning to achieve your long-term financial goals. So Greater Atlanta Builds Credit is a fairly new financial capability program in the greater Metro Atlanta area. We provide resources that are designed to help our partners and their clients understand credit, and more specifically, understand how to use credit to become more financial resilient. We do this work by establishing partnerships with our community organizations, and those partnerships result in us providing access to professional development training for financial practitioners, providing client workshops, banking solutions, and credit building products or access to financial counseling. Greater Atlanta Builds Credit is available to provide resources to individual clients, as I mentioned, through financial counseling, or to community partners in terms of actually implementing resources and materials in existing programs. The next slide has our contact information. So if you're interested in finding more information out about GABC, please send us an email at info@greaterbuildscredit.com, or you can visit our website, which is under construction but still accessible, at www.greateratlbc.com. In case you're interested in connecting with a financial coach, you can certainly book an appointment with us through the link below at youcanbook.me. So without further ado, I'd like to turn the presentation over to D'Andrea Austin, who is a licensed realtor and actually a financial coach with GABC, followed by Mr. Scott Jefferies, a wealth management advisor with Northwestern Mutual. Thank you so much for inviting us, and we're excited to join you this evening. D'Andrea, take it away.
Okay. Thank you so much. So what we're going to talk about this evening, I'm going to really just kind of share with you the role of a financial coach, some things that you would expect to receive in interacting with a financial coach, and just kind of some tools and tips in reference to how you can manage your resources and different ways and strategies to improve your overall financial mobility. So what is the role of a financial coach? So a financial coach's role is really just to offer you education tools, resources, and encouragement. Financial coaching is more client-led. So our goal is to ensure that we are helping you meet your financial goals that are directed by you. So we're just more of your accountability partners. So we help you uncover your financial goals and your needs. We assist you with defining clear objectives and priorities. We want to make sure that we are providing you education, guidance, and accountability. We're just your accountability coach, and we want to support you through the process to accomplish your goals, whatever goals you set to be able to accomplish those. So I like to say it's the 3 E's: educate, encourage, and empower. That's the purpose of financial coaching, and that's the value of providing services as a financial coach. So kind of how do we support you? So a financial coach's main role is to empower you, like I said, with the knowledge and skills and confidence that you need to make quality financial decisions. Our objectives and our outcome based. That means that the primary goal is to improve your financial situation. We want to make sure that we help you achieve your goals, your defined goals, address your immediate needs, improve your financial situation, change and help you, above all, change your financial behavior, facilitate decision making, and then provide you with the tools and the resources. So we want to make sure that we understand your financial position. Where are you right now? Where are you trying to go? And how do we help you get there? We want to make sure that whatever your needs are, whatever your concerns are, that we are addressing that we are uncovering, the root cause of potentially why and where you may be, where your barriers are, where you may be having some challenges with your financial circumstances. And then we want to help you prioritize those goals and then provide you with the resources, with the information and the knowledge to support you through that process, to give you the tools and the resources. And then we want to support you through that. So, we want to make sure that we're helping you review your progress, to track your goals, and to celebrate any of those accomplishments along the way. So what do you expect? So what happens in a financial coaching session? So initially, we're going to meet with a client. We're going to assess your current financial situation. And then we're going to try to understand your financial concerns and your goals. Then we're going to kind of, once we identify those goals, we're going to put an action plan. We're going to put some steps in place to help you to identify those goals and to help you accomplish those. Then we're going to come up with a game plan as to when those action steps will be completed and what type of support that you're going to need through that process. And then we're going to help you, of course, define a system, a budgeting system, so that we can determine kind of where your money is going and where we can kind of free up resources to ensure that to help you meet those financial goals. If it's debt reduction or savings, we're going to help you come up with a plan for that. And then we're going to do our check-ins. So typically when you meet with a financial coach, you're going to check in once a month. We check in once a month, and then we typically have a monthly meeting, a monthly session, and then we do an additional check-in just to kind of gauge and see how you're doing and if we need to make any adjustments in your action plan. So again, we're going to understand where you are. We want to assess your financial situation. We want to help you create a budget or savings plan, a spending plan to determine where your money is going. And then we're going to help you create some smart financial goals, realistic and quantifiable goals to assist you to progress towards your success. And then we want to work with you to do some step-by-step action planning to help you progress towards meeting those goals. So when you meet with your financial coach, or just some tools and tips on how to create goals. So when we're creating goals, we believe that the goals should be smart. So we want to make sure that we create smart goals. And what I suggest here is that when you're thinking about your goals and truly setting appropriate goal setting, you should probably develop a chart of those goals, a goal chart indicating your financial objectives. That gives you an actual chart of something that you can actually view, something you can go back and take a look at, and it'll give you a visual so you can stay on track, and it keeps you to align you with the goals that you've set for yourself. So I suggest that you create a chart of your financial goals, so you can identify what those objectives are. Our smart goals should be specific, they should be measurable, obtainable, and they should be relevant and time bounding. So one thing I want to highlight here is the relevance of the SMART goal. When you're creating a goal and you're developing your financial goal chart, you want to make sure that as you're looking at your goals, that you state your why. Why am I setting this goal? What is my objective to meet this goal? What is my why behind that? When you develop your why with your goal strategy, that's going to help you stay on focus, stay in line. So when you create that goal chart, think about the why behind each objective, each item that you select. What is my why? Why do I need to meet this goal? How's this goal going to help me? What am I trying to accomplish here? And I think when you have that as your visual and you have your why statement attached to your goals, it helps you stay focused and stay on track with meeting those goals. And then we want to decide if your goals are short-term or long-term. So when you develop that financial chart, when you're looking at your goals and you've outlined those goals on your chart, are these short-term goals? They may even be midterm goals. They may not be quite as short. Short would be a year or below or under a year. Maybe they're a year and a half or 2 years. That may be considered a midterm goal. And then you have your long-term goals. So once you identify your goals, then you're going to determine if they're short-term, maybe midterm, or long-term goals. And then we want to ensure that your ambitions are SMART, that your goals are easy to determine, easy to describe, that you can monitor those, you can monitor the success, and that within that you can measure the achievement if it's within your goal to achieve. And then your goals need to be practical and sensible, and they should have specific milestones to achieve. Now, one thing I want to highlight is that a goal that you can achieve versus being realistic or relevant. Sometimes there are goals that we can create that we can actually achieve, but does it make sense for us to set that goal? For an example, I want to save $5,000 in 3 months. Can you achieve that? Does your resources say that you can potentially, if you move several things aside? Does it allow you to achieve that goal? But is that really realistic within your financial situation, within your financial footprint are you going to actually make those adjustments? And is it practical and sensible to actually meet that goal in that time frame? So when you look at goals that you can actually achieve, you also want to make sure that they actually make sense, that they're relevant, and that they are realistic, they're sensible goals, and that you set the appropriate time frame for that to meet those goals. And then, of course, we want to talk about our spend plan, because with a goal, we got to have a spend plan. We have to know. We have to have something in place in order to actually meet those goals. So when you're creating a spend plan, it's a little different. I like to say that a spend plan is a little different than a budget. So a budget, it's very similar, but it's a little different. So a budget kind of shows you kind of how your money's already been spent. So you're going to create your budget. You're going to decide, how have I already spent my money? And the spend plan is how I would like to say is a plan of how you're about to spend your money. How am I going to spend my money going forward? Now that I understand where my resources are, I've already made a list of my household expenses. I've monitored that. I understand all of the items here, including transportation, groceries, and any other essentials. You want to outline that. And then you want to add up your monthly take home, and of course, and then you want to subtract those expenses. Once you've identified that, once you've kind of measured that through budgeting, then you can decide, you can determine what your plan needs to look like going forward and how you plan to spend your money. Then you want to list out some of those additional financial priorities like debt reduction, emergency savings, retirement, or even planning for your special needs child. Should something happen, you want to consider those areas to add to your spend plan. So again, like I said, a budget, we're going to kind of look at, what we've spent, and then our spend plan is really kind of how we plan to move the needle and how we plan to spend our money going forward. Okay. And also, once we've established our goals, we've established our budget, within that, there should be some additional options or goals for saving. And then potentially, depending on where we are in our debt ratios, or if we have debt management, we want to reduce that debt. We know that debt, it will actually eliminate or creates barriers for us to save, barriers for us to invest in and plan for our future. So we want to make sure that we have a strategy to reduce debt if we actually have debt that we're considering. So some standard strategies for meeting some of your savings goals. So how will we strategize that? Again, it's about defining your savings goals, and your savings goals can be multiple goals all at once. That may look like you planning for retirement. So you may have your 401k, your IRA, planning for your emergency fund, and then or planning for your special needs child in a special needs trust, or any other services that are available that you have decided that you want to set aside resources for to plan for. So you want to define those savings goals. And then you want to set deadlines on those. So again, very similar to your SMART goals, you want to have savings goals with specific deadlines. Then you want to break your goals down into smaller goals. Again, like those buckets I indicated. How much am I going to allocate for my retirement? How much do I need to allocate to meet my goals for my emergency savings or my savings plan? What do I need to set aside to care for my special needs child? So you want to break those down into smaller goals and to smaller buckets. And then you want to create different accounts for those goals. And then, of course, you want to automate those. It makes it life much easier if you're automating those goals and they just come out and they're dispersed, and you're not having to manually move those resources around. And then you want to track those goals. You want to see how well you're trending towards the goal that you set initially for yourself, for your savings. And then when it comes to debt reduction, there's a couple different strategies that you can use to eliminate debt. There's a couple approaches. So one approach is considered the debt avalanche method. This involves making minimum payments on all your debts and then using any extra funds to pay off the debt with the highest interest rate. And then we have that debt snowball method. So that involves making minimum payments on all debts, then paying off their smaller debts first before moving on to bigger debts. So how do you decide which process you would implement? So a good example would be if you have credit card debt that you want to kind of eliminate. And one of those credit cards has a really high interest rate of maybe 28%. And then one may have a lower interest rate of 14%. You may want to consider the debt avalanche method because that allows you to pay down those larger interest rate credit cards while paying the minimum on the lower rate credit cards. So maybe the debt avalanche method may be appropriate for you. And then let's just say all of your credit cards, like most credit cards we know, are all around the same amount. They're all one's 28, one's 27%. So you may want to consider the debt snowball method. That method allows you to take the smaller credit card, pay that off, and then move on and on to the larger credit card. So if you had a choice to meet or opportunity to meet with your financial planner, these are some of the options, some strategies that they would discuss with you on which method would be the most appropriate for you, depending on your financial situation. Also helping you identify your savings goals and what that would look out like and how to outline those steps to accomplish those goals as well. And then another area of opportunity would be understanding how to monitor your credit. If you decide that you're interested in even meeting with a financial coach or even with a financial planner, credit is an area, potentially an area that we would need to kind of look at. So when looking at your credit report, there's 3 different credit reporting monitoring systems. That's Equifax. The main 3 are Equifax, Experian, and TransUnion. And then there's 2 different credit score models. That's your FICO score and then your Vantage score. And then you have a series of monitoring bureaus, major bureaus, your credit card processing programs, your banks, your credit unions. And then of course, if you were to meet with your financial coach, we would pull your credit and we would help you monitor that. So these scoring models perform statistical analysis on the contents of your actual credit score. So your history of borrowing and repaying debt, and then it records, how the scoring models take a look at the patterns in your credit report. Based on these patterns, on-time payments, for example, late payments, credit utilization, scores models assess an actual score, usually in the form of 3 digits, the number that reflects what they're predicting, how risky it is to lend money to you. So when you're looking at checking your score and kind of identifying where you are, there's some great options out there, a lot of free options out there now. It's easier to access your credit score. Of course, you always want to pull that annual credit report. That's a free credit report that gives you access to all 3 credit bureaus on an annual basis. And it's important that you understand all of your credit scoring and those items that are there. When major bureaus, credit card programs, and banks look at your credit scores, they all look at different ones and they can all be different. They all can report something different. There may be one item that is reported on one credit bureau and it's not necessarily reported by another credit reporting entity. And that's where you will see variations in your credit score, potentially 10, 20 points, just depending on what those credit scoring, what that item is that is reported on one and may not be reported on the other. So it's important that you understand all 3 credit reports, that you have a chance to look at that and that you do a deep dive and evaluate and understand what's on there. Because oftentimes there are things on your credit report that shouldn't even be on there. And maybe there's an opportunity to dispute something that will make an immediate impact on your credit. So annualcreditreport.com is a free credit report that gives you all 3. You have the option to pull that every year. You have My Equifax, we have Credit Karma, and then several of your banking institutions offer you free FICO scoring or free credit scoring that you can just pull right off of the website or pull right off of your account. When you go look at your account, you just kind of go right out there and look at the scoring that they've identified. And you can typically look at that on a monthly basis. So there's definitely so many different ways to have access and review your credit and understand where you are credit wise and the things, what we need to work on to improve that if credit is an area of opportunity for you. So FICO and Vantage scoring models, typically most of our financial institutions, when it comes to lending and borrowing, will be looking at your FICO 8. That's the most well-known FICO scoring system. It would be the FICO 8 scoring system, and that's typically where most lenders will utilize that scoring matrix to assess your credit worthiness. So when we're looking at the ranges, of course, we have the Vantage score, which typically the scoring is very similar. When you're looking at FICO score, they could be different from your Vantage score, but their Vantage scoring and additional FICO scoring is becoming more popular. So with FICO 8, there's also FICO 9, and then there's your Vantage scoring. FICO 8 is going to look at all of your credit history based upon your credit card services. Your FICO 9, your Vantage score, will also look at things like rent reporting and utility, how well you're paying your utilities if you choose to participate in any of those programs that report that. It's not always considered when they're assessing credit, but they will look at it. So it still gives you some history, especially if you're looking to rent something or as you're working to build your credit. It is something they will also take into consideration when you're actually looking to make purchases or looking to utilize your credit. Those range, our credit scoring can range from, an exceptional credit score, typically between your 8 to 850s. And then your excellent credit scores anywhere between that 780 to 850. Typically anywhere between 750 and above is exceptional, is excellent. And you're typically not going to have any challenges with any area or anything that you're interested in purchasing that is based on your credit scoring. Fair scores, typically around that 670 to 730. When you're looking to purchase a home, I think right now, 2022, they're looking at credit scores around that 650 mark and above. Although some lenders will look at credit scores a little lower than that, but typically if you're in that 650 or above, you shouldn't have any issues obtaining credit if you're looking to purchase a home. Okay, we just want to give you some additional resources where you can, if you want to understand a little bit more about how to manage your money. And so we have our FDIC, How Money Smart Are You? It's a series of workshops and ways that you can go out there and just identify information or get information on tools and resources on how to better manage your resources. We have our free credit reports and scorings. Get your free credit report through Equifax. These are some free reports services. And you've got your free credit score. And again, I mentioned your annualcreditreport.com. These are some free credit reporting and scoring. You have your debt reduction tools here. We have Dave Ramsey as an option. The snowball method, how it works. Debt repayment calculators. So these are just some great links. And I think this will be shared with you on where you can go and get additional information on resources for budgeting, savings, and managing your other areas of finance. So now I just want to talk to you a little bit about a financial planner. So I just wanted to cover those things. And if you're interested in financial coaching, these are some things that your financial coach would go over with you, would sit down with you and assist you with those opportunities and help you create a plan, goal setting, and identify where you are in your current financial situation. Also, another resource is a financial planner. So what is a financial planner? A financial planner is a qualified financial advisor. So just want to say that a financial coach is not a financial advisor, but a financial planner would be your financial advisor. They're qualified financial advisors who provide comprehensive money management services, including advice on long-term savings, investing, insurance, tax, retirement, and estate planning. So the benefits of financial planning: financial planners, they help you evaluate your existing financial position and create strategies to help you meet your financial goals. The financial planning process helps you identify where your financial needs exist and where risk arise. So may arise, they're going to help you identify those risks and help you cover those risk gaps. Okay. So financial coaching versus financial planning. So I want to say that the financial coaching and financial planning both provide a unique value to you as a client. Financial coaches, we focus more on goal setting from a financial behavior change approach. Our goal is to help you employ or promote positive financial behavior change. We know that it takes a while and it takes an accountability partner often to invoke change, especially when it comes to finances. And we need assistance. Our goal is to be there to be your accountability partner to help you make those changes. Typically, it takes 3 to 6 months in order to implement a change, and up to a year to ensure that that becomes a part of your habit. So our goal is to help you create those positive behavior changes and to support you through that process until you feel confident that you can manage that process on your own. So a financial planner, they focus more on goal setting from a risk management and an investment approach. So if you need a coach for coaching, remember that coaching is needed to help you organize your finances, create a budget, pay down some debt, and begin to save, potentially begin your savings process and save for emergencies or whatever your short-term savings goals are. Typically, your financial coach will help you with that. And we're there to be your accountability partner, meet with you on a monthly basis, and to support you through that process. Your financial planner is needed to guide you on investment, insurance needs, college savings, tax planning, that special needs trust, and potentially estate planning. This is where your financial planner was going to step in, and they're going to guide you through those longer term areas of opportunity and help you cover those gaps where potentially you may have some gaps with insurance needs, or you have some areas that you want to really assess where you are tax wise. And so your financial planner is there to support you in those areas. So again, financial coaching and financial planning are both unique values to the client. There's no one or the other. You can utilize both strategies and both resources, and we recommend that you take advantage of both of those resources. So that's all I have. I'm going to go ahead and I'm going to turn this opportunity over to Scott and allow him to give you an overview of the financial planning strategy and resources that are available through him as a financial planner.
All right, thank you, Deandra. Can everybody see me, I hope? Or are we still sharing?
Did you want to share your screen, Scott? I just want to.
Yeah,
okay.
I'll do that.
Okay.
There you go.
I think we have some questions. Let's see here.
All right, cool. Well, I'm definitely seeing lots of questions, and we will get to all of these later on at the end when we have opportunity to answer questions. So as I said, I'm a financial planner. I've been working with families of all kinds for about 20 years. And my son was born with Down syndrome back in 2005. And I realized I didn't know much about planning and how it would be different for me having a child with special needs. So I started this journey to uncover what was different. And after passing a CFP exam to become a certified financial planner, you think we would know this stuff, but there was literally not one question on the exam that was applicable to our families. So this has become a passion of mine, is working with families that have similar situations. I'm trying to keep this meeting to really talk about financial planning and not focus on things like special needs trusts. Now, we're going to talk about them because they're important, but what I really wanted to talk about was general financial planning for the families and how we can protect and take care of our loved ones long term. At the core, financial planning isn't that much different for us having a child with special needs. Now, we're going to use some things a little bit differently. Somebody mentioned in the chat box about our kids not being able to have assets over $2,000, and that's important, and we definitely want to avoid that. But all the parents on this panel are different, but all of us have similar goals in that we want to raise our kids, we want to educate our kids, and we want to have some financial security. We want to feel financially secure, be able to sleep at night. So those goals are the same, whether you have a child with special needs or not. And a lot of the tools, the good news is that you're going to use are the same tools that your neighbors are going to use. We're going to use retirement plans like 401ks. We're going to use Roth IRAs. We're going to use all the same investment tools. So all of that I'm speaking about right now is largely going to be about the parents and their financial situation. So we don't want to put money in our kids' names, but we want to build up our own net worth and our own assets where we can help take care of our kids long term. Every family on this call is different. So I'm going to speak in very general terms, but everybody here lives a different lifestyle. There's some of you that live on lifestyles of $20,000 a month. Some of you live on $4,000 a month. And then there's numbers that are bigger and smaller than all those numbers. But all of us want to duplicate that income and be able to provide for our kids long term and for ourselves. We all want to retire at some point with the dignity and the lifestyle that we're grown accustomed to. So financial plan, let's talk about offense and defense. It's football season. There were some great playoff games this weekend, so I'm going to use some football analogies. You want to have an offense, a great offense. That's what everybody gets excited about. But we've all probably heard the phrase that defense wins championships. Well, defense also can lose a championship. If you watch the Buffalo Bills Kansas City game this weekend, when Buffalo let them score 2 touchdowns in a minute and a half and lost the game. So we need to have some defensive planning. And this really segues very well into Deandra's talk about living within your means. When I run into clients that want to do some financial planning, but when we review their budget, we realize they just don't have any extra money because they're spending it all. They might have tons of credit card debt. I mean, I've sat down with people who said, I've got a little credit card debt. And then I ask them what the number is, and you wouldn't believe some of the numbers. I mean, I had somebody tell me $75,000 was a little bit of credit card debt. I mean, I wanted to fall out of my chair because I wouldn't be able to sleep at night having that kind of credit card debt paying 20% interest on. So it's really important that we live within our means and do a budget. You know, work with somebody like Deandra or yourself and just do a budget. Figure out where your money's going. I think as Americans, we're all guilty of just spending. And if we make X amount of money each month, mostly we're going to spend most of that X. But we need to do a budget. So I would encourage everybody to, over the next 6 months, document your expenses. You know, do an Excel spreadsheet, figure out where all your money is going, and categorize everything from mortgage to car payments to insurance to eating out, gas for your car, etc. And then we can categorize those expenses between critical expenses, things that aren't going to go away. You have to spend it every month. And then the expenses that you could cut if you needed to. And once we have a budget, then we can figure out how much more can we save? Are we saving enough? I mean, I've run into so many people over the years that are making $500,000 a year, and you look at their balance sheet and they have no savings because they're spending it all. So let's figure out where's the leakage and where can we save. Next thing is having an emergency fund. You know, 3 to 6 months worth of your expenses need to be in somewhere that's safe and readily accessible in case of an emergency. I encourage families that have one primary earner to have closer to 6 months. If you have 2 earners that are equal, then we can be closer to 3 months. But at the end of the day, if somebody loses their job, gets sick or hurt, we need to make sure that there's money there where they don't have to credit cards. Where if there's an opportunity to send your kid to camp that costs $3,000, you don't have to put it on a credit card. So build up that emergency fund for these rainy days. Use your credit intelligently. You know, don't have a bunch of dumb credit card debt at 20-something%. If you're using credit, use it wisely. An example would be, I bought a car a few years ago. I bought a gently used car and I put down a little bit of money, but they were financing me at 1.9%. So to me, I didn't want to take money out of an investment account earning 8 to 10% when I can borrow at 1.9. So use credit wisely and make sure it all fits within your budget. Also, insurance, medical insurance, disability insurance, life insurance. This is something that we need to review if you haven't done a formal review on it. Things like disability insurance is probably the most underutilized insurance out there. Most people that work for a large company have protection through their employer that if they get sick or hurt and can't work, they're going to have some amount of income continue. It's typically 60%. Now, if we've done a budget, most of us can't live on 60% of our income. If we're honest, we look at what we're spending and they're spending more than 60%. So we should supplement that disability coverage. and make sure that if something happens where you can't go to work the next day, your income will continue. Life insurance. Obviously, it's invaluable for families that have loved ones that are going to need their support long term. There's various kinds of life insurance. The most popular is term insurance, and term insurance is temporary coverage. The most common policy is a 20-year term policy. I think when people first started selling it, the idea was 20 years gets most kids out of the house. So if you bought $1 million of term insurance, it lasted 20 years. Hopefully your kids didn't need you after those 20 years. Now, a lot of us on this call are going to have kids that may have some needs beyond 20 years. And in that case, you might want to look at a permanent policy, something that lasts forever, something that'll pay out if you die at 75, you die at 85. And that way you have a guaranteed legacy that's going to be there. And that's a perfect vehicle to funding a special needs trust for our loved ones. All right, so let's talk about some fun stuff now, since I've went through a lot of the boring things. Let's talk about the offense. So I mentioned that a lot of the tools that we're going to use are going to be the same tools that everybody's using. Let me share some stuff here. All right, Deandra, I think I can't share a screen for some reason. Maybe you're still shared.
Oh, I'm not sharing.
Okay.
I stopped.
That for you real fast.
All right, well, I'll keep talking since we have time. So a lot of the tools that we're going to use are the same tools that everybody uses. If you work for a company, you may have a 401k available to you. We need to be taking advantage of that 401k. Just to get really basic, a 401k, you're using pre-tax money to go into an account. The money grows tax deferred for retirement. Most people that I talk to are putting money in a 401k, but it's typically nowhere near the maximum. People tell me all the time, I'm contributing the max. And then I look at what they're contributing and they're nowhere near the max. And in a second, I'll pull up the screen that shows what the max is. But for a 401k, you can put in $19,500 a year. So for somebody that's making $100,000 a year, to use simple math, it's about 19.5% of your income that you should be deferring if you wanted to max out your 401k contribution. But people tell me they're maxing it out, but then we do the math and they're doing 3, 4, 5%. And typically what they're doing is they're maxing out the contribution that will get an employer match. So with a 401k, typically your employer is going to match your contributions dollar for dollar up to a certain percentage. And a lot of times that's 4 or 5%. So what do I find? I find most people are putting in 4 or 5% into their 401k. And to have the type of retirement that we all want, you need to be saving more than that. I'll back up a little bit while we figure out the screen sharing. So for a financial planning perspective, one of the first things that I'm going to do is work within your budget and figure out what are your long-term needs. So every family, again, on this call has a different goal for retirement, but typically it's going to have a similar income to what they're used to. So if you're currently living on, say, $8,000 a month, the start of our financial plan is going to be for me to figure out how to duplicate that $8,000 a month in retirement. So we're going to look at what assets do you currently have, things like 401ks, IRAs, et cetera. And we're going to anticipate and make some predictions using history and what your contributions are to figure out what is that going to be worth at retirement. Then we're going to look at income sources that you're going to have in retirement, things like Social Security. Some of you on this call may have pensions. Those are kind of going the way of the dodo bird, but some people still do. If you're a teacher, you have a pension. And those pensions can be invaluable when we look at your retirement goals. So let's look at what income is coming in, and then what is the shortfall between what your goals are. Now, a lot of you on this call are thinking about your loved ones and what are their needs going to be long-term. So we have to factor that in. So in the case of my son, he's a sophomore in high school. So I have a pretty good indication now at what his future capabilities are going to be. He's probably not going to be able to support himself. He's going to need help. So my retirement goal for my family is to duplicate the current standard of living. And then I've added in a supplement for Jake to make sure that he's taken care of long term. And I still can't share the screen. So in the case of Jake, what are his needs and what is his income goal? I don't know. There's a lot of different ways that we can be supporting him long term. Some of you on this call, your loved ones may be living with you for the rest of your life. Maybe that's your game plan. And that is the default for a lot of families, is their loved one lives with them. I mean, Jake can live in his bedroom, his childhood bedroom, for the rest of his life. And my expenses to support him aren't going to be that tremendously different than if it's just me and my wife living here, right? But that's not my goal for Jake. And I hope Jake can live an independent life at some point. And how independent, it depends. So I've seen families buy a townhouse or a duplex and live in one side of the duplex and their loved one lives in the other one. I've had other people finish their basement. I've had other people build a detached garage with an apartment above it. So those are options. And finally, the last option is to truly live somewhere independently or with supports. An example would be a place out in Swanee called Annandale Village. There's another one, Just People, around town. I toured Annandale. It was wonderful. It was really neat. It cost $3,500 a month. So if Jake were to live in an Annandale, I need to add that $3,500 to my monthly retirement budget. So I have my goal for what Melissa and I want to live on, but then I've added in Jake's income needs to live somewhere like that. So expenses for our kids can be very small if they live with us. And they can also be pretty big if we chose the all-inclusive option. For those of you that stayed in an all-inclusive resort, Annandale is the all-inclusive. It's a little more expensive, certainly, but you'll have a very independent life. Tools. So I'm getting thrown off because I can't share the screen here. Let me try it one more time. Wait a minute. Now I might have figured something out how I can do it. Cool. All right. I just have to back into it. All right. So all of these attachments we're going to send out to all of you. So don't memorize this stuff. Don't try to write things down. But here are some of the tools that people are going to use for retirement. And most common ones is top line is the 401k. And the maximum contribution is $19,500. For those of you on the call that are age 50 plus, you guys can do another $6,500. So you guys can put $26,000 a year away for retirement. Skip down about 3/4 of the way down to the Roth IRA. I love Roth IRAs. For those of you that are eligible to do a Roth IRA, I encourage all of you to do those. You can put in up to $6,000 a year, and that money grows tax-free for retirement.
Scott, Scott, we're not seeing your slides.
Really?
We're seeing your screen. Yeah, we can see your emails.
No, we don't want that.
So we can see your screen. It's just the wrong window.
You might have to stop share and then share again.
Yeah,
share the right window. Yeah.
Window. All right, so I'm opening my email. You should see my email. Now I'm opening up my presentation. Is that not working?
No, we still just see your email.
Okay, well, never mind then.
You want to open up your presentation first.
Yeah, open up the presentation first
and then share your screen.
All right, let's try that. Sorry for the technical difficulties, everybody.
Oh, it happens. I think everyone's been on this with this happening before. Gotta love technology.
One more time. Now when I open up window, it's not there. Huh.
Well, just so everyone knows tonight, even if we are not able to get Scott's screen shared with the correct presentation, we will make sure that everyone receives this information through email. So no need to worry. We'll make sure you get this.
Okay. All right. Well, sorry about that, everybody. We'll try again. because I've got some good stuff and I want you guys to see all of it. So we're going to make sure you get it. So I want you guys to save and invest, and those are some of the tools that we're going to use. Now, let's talk about what's different. And the big one is the ABLE account. Most of you guys have heard of an ABLE account probably at this point. An ABLE account is really a great Swiss Army knife tool for us to use for our kids. And this is something that our kids can actually have money in their name and not disqualify them from benefits. So with an ABLE account, it works off the chassis of 529 college savings plans. Congress a few years back
There we go.
authorized these. And with them, you can put in money and the money grows tax-free for our loved ones and does not disqualify them from government benefits. So we can put money in these accounts and it can be an investment if we chose for it to be. And we can put in up to $15,000 a year and that money grows tax-free. And our loved ones can spend the money on a very broad list of disability related expenses. But you'll find if you read the disability related expenses, they're pretty much everything. Who's sharing the screen right now? Not me. So with the ABLE account, the Georgia Stable is.
I'm sharing that for you, Scott. This is DeAndrea. You're welcome.
All right, the Georgia Stable account is the Georgia version, and you guys can just Google Georgia Stable account. I love the Georgia Stable account. One of the features that I like about it is it comes with a debit card. So your child can actually have some independence and have that card and use it at, grocery store, going out to eat. But it has some neat features that can keep us from having our kids get taken advantage of. My son loves to eat and he loves Taco Mac, he loves Chick-fil-A, and if he could go there, he would spend a lot of money there every day. So you can limit and actually eliminate certain places where they can't spend money on. So if you have a child that likes to go on Amazon and buy things, you can put a limitation on how much money they can spend at Amazon. They can't spend more than $100 in a transaction. So we can protect our loved ones, but still give them some autonomy to use their money. If our loved one has a job and makes some money, they can deposit their paycheck into that account. So in addition to the $15,000 that we can put into this account annually, they can put in a portion of their income. And the number is on my slide, which I can't show, but we'll get that out to you. But I think it's $13,000. So between the two, they can put in a lot of money and use it really as a checking account. I had an attorney who focuses on families with special needs tell me he considered it legal money laundering. He said, you put money in this account and it keeps them eligible for benefits. So one of the tricks for our kids is if they do have a job, we're trying to manage their income and their assets to stay below these limits. So having this ABLE account as a place that they can deposit their money in keeps their checking account and savings account below the $2,000 limit that can mess up their government benefits. So an ABLE account is really critical. So the Georgia Stable account, I love, that's the one I have set up for Jake. The other one is one that I can help you with, is the ABLE America plan. This one is offered by the American Funds, which is a really, really great mutual fund company. And if you're using it more as an investment, I like ABLE America because I like their investment options. So if you're going to use it more as a checking and debit card situation, do the Stable account for sure. If you're wanting to really grow that money, let's do ABLE America. Now let's talk about some of the limitations with an ABLE account. So you can only put an X amount of money every year, 15,000 plus the contribution for their earnings. So you can't put in a ton of money. So if somebody were to pass away, they can't generally fund an ABLE account with anything truly significant. So an ABLE account is not good for inheritances. That's where a special needs trust needs to come in. So for big money, I tell people special needs trust. For smaller money, ABLE accounts are perfect. Also, with an ABLE account, that money, when our loved one passes away, Medicaid has a little clawback where they can look at the money that's in that account and figure out what benefits they've paid out to your son or daughter, and they can actually get some of what's left in that account to pay themselves back. So an ABLE account could end up going back to Medicaid when your son or daughter passes. So that's something to keep in mind. But the big one is $100,000 is the limitation to how much money you can have into that account and still qualify for SSI. So for our kids that are going to be getting SSI, Social Security, it's roughly $800 a month of income. We can't have more than $100,000 in the account. So if you save and diligently, you could get $100,000 in the account. And in most of our cases, if we're wanting to provide for our loved ones long term, we're going to need a lot more than 100,000. So an ABLE account is a great tool. It's a Swiss Army knife tool, and it does a lot of things, but it has some limitations. So we're going to still need a special needs trust to have most of the assets that we're going to leave for our kids long term. Now, what are those assets going to be? The good news is they're all going to be the same things that you're saving and investing for your retirement, for your long-term goals. So 401ks, those can all get directed to a special needs trust. Roth IRAs, special needs trust. A house, if you have a second home, all of these things can be owned by a special needs trust. So the good news is for us as parents, our planning right now is just save and invest for ourselves and to provide for our loved one. But we're not going to put money in a special needs trust yet. I want my special needs trust for Jake will get funded when I die and not before that. So I set up a special needs trust. I put in $50 and Jake has a trust fund. And if somebody passes away and wants to leave him money, we have a receptacle for him. But my goal with that trust is not to put money in it now. My goal is to save and invest for me, for my wife, and to have money to take care of Jake, but I'm not going to give up control of that money yet. So all the families on this call, you need to be saving and investing to take care of your loved one, but you're going to use the same tools as everybody else. We just can't give it directly to our kids. We have to give it to that third-party special needs trust. And if you are wanting to save and invest for your kids now, then I'd encourage you to use an ABLE account, either the Georgia Stable or ABLE America. Either one of those are great tools to save and invest for our kids. Let's see, what else? Without being able to go over the documents that I have on there, that is pretty much it that I have. So I'd like to look at the chat room and see what kind of questions we have. Okay, Sarah looks like to be the one that's asking the questions for the group. So let me go with you. Do you have to pay taxes on assets in an ABLE account? No, that's one of the great advantages of an ABLE account is that it grows tax-free. No taxes. Now you use after-tax money to go in, so you don't get a tax deduction on money you contribute, but that money grows tax-free. So that's another huge advantage of an ABLE account. So if you were to have a special needs trust for your child and you put in, I don't know, you have $10,000 in it and it was invested, it's going to earn money every year. Well, you have to file a tax return on that trust, which can be expensive. So you don't want to have a trust fund just sitting there with a lot of money in it that you're paying taxes on every year, filing a tax return for, when you have an ABLE account that can do the same thing. So I'd encourage anybody that's wanting to invest for your kid now, don't do it in a third-party trust. Either you own the money and spend it on behalf of your child or put it in an ABLE account. But leave that special needs trust with a minimal amount of money until you pass away. What kind of receptacle do you use prior to a special trust? I'm thinking I'm understanding what you mean. It's like, where do you put money prior to a special needs trust? I mean, you put it in the same things that everybody else is doing. You contribute to your 401k, Roth IRAs. You can set up a regular investment account. You can put it in any number of investments anywhere you want. But when you pass, you're going to direct it to a special needs trust. So it's going to go to that special needs trust only when you die or when you're wanting to fund it, which is typically when we die, right? We want to fund it when we're no longer there to provide. Now, in my case, my planning, most of my money when I pass, assuming I goes first, goes to my wife. I'm not really funding the special needs trust until we both are gone. There's different situations and everybody's different. Some of you may want to fund a special needs trust, especially if you have a second marriage going on. You might want to say, hey, I need to take care of my son or daughter first. So every situation is different, but most of the money that I have is going to pass to my wife at my death, unless I go last. When I go last, special needs trust is funded. Let's see what else we got here.
We got a couple of good ones over here, Scott, from
Okay.
and looks like Sarah again.
Mary, very good question. My understanding is still the 15,000. I need to get some clarification on that, but yes, you can transfer 15,000. So if you have a large 529 plan, you may have to do it over some years. The good news is it's a non-issue, right? So if you transfer it over a few years, it has the same tax treatment. So the money that's in that 529 is growing tax-free. So just roll over 15,000 every year if that's what we have to do. But let me get some clarification on that, and I will get back to you on that. Okay, what if Grant left money to son and died before he was diagnosed? Okay, so this is a problem. And depending on the age of your son or daughter and how much money it is, there are different options. The first is spend it. If they're a minor, you can spend it if it's a small amount of money. You can buy lots of things with it. Somehow get it into your name. But if it is in their name, what you have to do is put it in what's called a first party special needs trust, or contribute it to those ABLE accounts. So what is a first party special needs trust? It's the same as the other special needs trusts I've been referring to, but with some very important distinctions. A first party special needs trust is using that person's money. It's not the parent's money, it's their money. So in your case, that money was your son's. So he can transfer it to his own special needs trust, and then he'll all of a sudden be eligible for benefits again. The bad news is when he passes away, like an ABLE account, Medicaid can go after what's left in that account to get paid back. So for families that have a first party special needs trust, I encourage them to spend that money first, right? So third party trusts and all these other things, don't spend that money, spend the first party trust. Because my goal would be have that number hit 0 when your son passes away. And that way Medicaid doesn't get paid back, and all the rest of the money's in your third party trust, which will go to the beneficiaries of your choice. So if you have other kids, when your son eventually passes, that money can go to other members of the family. Whereas that first party trust money will end up going back to Medicaid.
Okay, awesome.
I'm sorry, I just wanted to answer one question. Someone had a question about like a sample budget, an example of a budget model, and I just wanted to kind of share that. So I'm going to share kind of this, what we use to kind of help create budgets or spending plans. This kind of, it's a couple numbers in here. So basically, like Scott said, it's just a basic spreadsheet, but it allows you to outline all of your expenses. And then the way we kind of have it here, it allows you to put in every specific item, your current amounts, what you're spending right now, which is the budget portion. And then we have a plan section, what you're expecting to spend based upon what you've identified are your existing expenditures, things that you spend. And it gives you that flexibility to say, wow, I'm spending a whole lot of money on takeout. Maybe I shouldn't be spending $400. Let me put some tweaks in there. Maybe I can trim that back and reduce that. And so it gives you some flexibility to identify those areas of opportunity where you have wiggle room. And it gives you your overall expenses. And then you're going to look at what your income is. So in addition to this, there's some categories you want to add your expenses. Then you're going to want to add your monthly income. And that depends on it can be multiple ways. You may have income from different sources, but you want to add all of your income sources there. Once you've added your expenses, your income sources, then we have, what's your cushion? Do we have anything left over? If there's nothing left over, we probably want to go back up here and tweak some of these negotiable items. And it depends on what that is. It could be personal care for you. It could be entertainment activities. And what's negotiable for some is not negotiable for all. I may have to eat out all the time because I'm just going to do that and I'm not going to change that. So, it may be something else. So you tailor this to whatever you feel is where you can make some provisions in your budget and where you can actually tweak that. And then you look at your cushion. What do I have left? You make your savings commitment. and then you have your remaining funds. Once you've decided on what that savings commitment, then you execute that plan, whatever those remaining funds are. You want to definitely have a little cushion, just because, but budgets and spending plans, they're going to vary. You're not going to be exact to the number. So you want to have a little bit of flexibility. You want to have a little bit of remaining funds, a little additional cash flow at the end, just in case, to make provisions for any adjustments. And then if there's quite a bit left, and then you can start looking at other options, whatever those options, whatever your cushion is, whether you're going to save, pay down debt, or whatever other priorities that you've kind of established. This is where you're going to identify those areas of opportunity. So I hope I answered the question that was posed in reference to how do you establish a budget, and what would that look like? And again, if you were to meet with a financial coach, we would definitely go through this process with you and kind of help you put this plan together.
Great. Thank you so much, DeAndrea.
Okay.
So I just want to make sure that we have gotten to all the questions that were asked at the beginning of the presentation as well, because I know there were a few, Scott, that I think would be really relevant for you. One of the first that were asked of the evening is, do you know if you can transfer money from a 529 to an able/stable account? And Scott, I know that you answered this privately to this individual, but if you wouldn't mind just elaborating on that a little bit for anyone else who might be interested in that information.
Sure. And I just did a little bit right here. I just did a little bit of research on that to confirm it. But yes, you can definitely contribute it from the 529 plan directly to an ABLE plan. The contribution limit, though, each year is $16,000 that you can do, which is kind of weird how it's a different number, but it's tied to what your annual gift exclusion is, which you can give to an individual tax-free. And for this year, that number is $16,000. So you can transfer $16,000 from a 529 plan directly to an ABLE plan each year. And that's a tax-free exchange. And then the money will continue to grow tax-free. So if you have a 529 with $100,000 in it, we can't transfer it all in one swoop, but you can do $16,000 a year.
That's really helpful. Thank you, Scott, for that information. I know there are a lot of families on tonight's call. There are some individuals that are looking for information. So feel free to ask any questions that you still have for our panelists. I'm just going through the list to make sure the questions that have already come in are answered tonight. Again, another reminder is that if there is something that you are not comfortable asking in a public forum, we will be sure that you receive all of our panelists' contact information so you can ask those questions privately as well. Our next question is around how to tailor communicating finance information, financial literacy information, and education to a person with autism. This can be answered by any of our panelists. Any best practices you've seen, any resources or tips?
All right, well, I'll jump in first. Every situation is different, right? I mean, all of our loved ones have different ways that we need to communicate with them. So the first thing I would do is talk to the parents and find out, how do they want me to do it? What's the best way to reach their son or daughter in a way that will be meaningful, that they'll get it? But I want to empower them. So I want to talk to them like they're an adult, because they largely are. I imagine ones we're talking about that you'd want me to talk to. So they're adults, and I want to talk to them like adults. And I will talk to them in the way that the parent tells me is the best way to communicate to their loved one, where it'll make sense.
I'm in agreement.
I don't have an easy answer.
I'm in agreement with Scott on that one. And, of course, we work with people at any level. So, just depending on what their comfort level is, where they want to start in their understanding, their comprehension. And that's kind of where you're going to start with that. And it can just be basics, just the basic, just basic understanding, there's checking in their savings account. So wherever they are in the process is kind of where we would, work with them to meet that need. And again, working with the parent to understand what that means of communication would look like for their particular child or their adult child. So
if there's somebody that has a job, they're making money, they have a checking account, those type of things, I would probably be encouraging them to use an ABLE account as their checking account, as their primary means of saving and investing. And I would teach them all about the advantages of it, the tax-free nature of it, the way the money grows tax-free. the debit card that comes with it. They have the independence to spend their money and still stay eligible for things like SSI and Medicaid, which can be crucial for our families. $800 a month's real money. I mean, that's $9,600 a year that we all would want to have our kids get if they can get it. But Medicaid is massive, and to have that Medicaid as their health insurance and have the ability to possibly get a Medicaid waiver, to have job transportation, housing, we want to protect those benefits, and this ABLE account is really the perfect tool to do that.
Absolutely. Thank you both so much for that information.
For young adults who's working. Okay.
We did just have a question come through asking specifically for any websites, workbooks, or other resources to recommend for a young adult who is working and is good with math, maybe as a great starting point for kind of figuring out their next steps.
That's a great idea.
I'll have to think on that one. I'm sure I can come up with some books and things that I would think would be helpful. But I don't have one ready to give right now.
Yes. Siobhán, I will provide some resources to you after the workshop.
Okay, wonderful. Thank you, Falita. And just so everyone knows, all the resources that were shared tonight, as well as those additional supporting documents that Falita just referenced, we will make sure that you have access to those. So tonight's program was really kind of a first conversation about financial literacy, covering a lot of information in a short time. We know that there is a lot of need around this conversation, especially when it comes to targeted conversations. So we saw questions come through about ABLE accounts, stable accounts, SSI, SSDI, navigating kind of those first steps when it comes to financial literacy for young adults with autism who are interested in having more control over their finances. So along with that information that will be sent your way after tonight's program, we will also be asking for your help. There will be a short survey where we will be asking you to let us know what information you are specifically looking for when it comes to financial literacy. Are you looking for more of the general information that DeAndrea shared? Are you looking for more targeted information, like around the different types of accounts that Scott talked about? Maybe you're looking for more resources around futures planning or navigating benefits. We are happy to work on creating content and programs around all of that. And that is really where our community serves as a resource, because we want to be sure that we're helping to empower all of you with the right information and resources as well. If you have any additional questions, anyone on tonight's call that you would like to add to the chat box, we do have a couple more minutes while we are waiting to see if those come through. DeAndrea, Scott, Falita, any final thoughts or information that you'd like to share?
All right, ladies, if you guys go first.
I just want to share that, kind of share my personal story, Scott. I also have a child who is autism on the autism spectrum. So I'm not just a financial coach. I'm also a parent, right here in the trenches with you. So I just wanted to let you know that it's not, we're not just here to just deliver information. We're also parents in the same position, also trying to make sure that we're establishing resources and positioning ourselves to make sure that we can care for our own kids as well. So I just wanted to share that personal story.
For me, I think the biggest takeaway that I want you guys to have is that financial planning, it's a process, and it's not that different from if you didn't have a child with autism. And that we need to get your financial house in order. And a lot of that overlaps with DeAndrea's talk about having financial coaching. And I wish everybody I spoke to was already in that situation before I got to them, because if you don't have those basics in place, there's not a lot I can do for you. I mean, my title is Wealth Management Advisor, so I need some money to help manage. It can be small. Don't think you have to be wealthy for me to help, but we do have to have some money, right? So for me to help you invest to meet your goals, we need to make sure that you have some money to save. Now, you can do that with very small amounts, don't get me wrong, but we do have to get you saving and investing and have your financial house in order. And you're going to use the same tools as everybody else largely, but we're going to add a couple little differences. And it's important that your advisor knows these things, because I ran into a client recently, a new client who had a big retirement account that's in their son's name. Now, it was a custodial account, but it's in that kid's name now. The kid's an adult, and they haven't been disclosing that on their SSI and Medicaid application, and the government hasn't caught them yet. I've explained to them they're committing Medicaid fraud. They got to fix this. So it's complicated. And the reason why this happened was somebody didn't know that this child or young adult can't own $250,000 in a retirement account. So your advisor needs to know these things and make sure that they have money directed to a special needs trust in these cases to keep them eligible for benefits. I just had another thought, something we didn't mention, because a lot of times parents ask me, well, Scott, I don't have a special needs trust. So who do I name as a beneficiary now on my life insurance and my retirement plans? Well, first, you'd probably want to name your spouse first. But if something happened to you and your spouse, you got to name somebody else. And our options aren't good. If we leave it to that child that's getting SSI and Medicaid, it can jeopardize those things. Other options that I see people do is they leave it to their other kids. They disinherit their child with special needs. And I don't think that's a good idea. And most of the attorneys I speak to don't think that's a good idea either. Because if you leave money to somebody else, it's their money. They do not have to use it on the child that you intended them to use it on. They can get sued, they can get a divorce. There's a million bad things that can happen to that money. So I would say still leave it to that child with special needs who's getting SSI and Medicaid. And then they're going to have to figure it out. They're going to have to transfer it to a first party trust, and all that bad stuff I mentioned earlier is going to happen. So I'd encourage you to go ahead and get that legal planning done. But in the meantime, you're going to probably have to name that child because there's not a good answer.
All right. Thank you so much, Scott, DeAndrea, Falita. It looks like we might have one more question that has come through. It's important to communicate about special needs trust to grandparents and aunts and uncles. That is a really great point made by one of our attendees for tonight. When it comes to financial planning, financial literacy, for anything involving special needs, it's always important that we are sure to communicate all of this as well. We know that there is so much more information that can be covered about all of these topics, and we are thrilled to see how many questions came through, the wide variety of information that was shared by our panelists tonight. We are approaching the end of our time, and as we mentioned, all this information will be available to all of our attendees, as well as those who registered and were unable to make it tonight. We also ask for your help in helping us identify where we go from here when it comes to the financial literacy conversation for individuals with autism and families and other community members who want to be involved in the conversation. So tomorrow morning, you will be receiving an email from our team with access to all the information shared, the contact information for all of our panelists, as well as that very short survey that we're asking for your help in identifying those questions, the areas that you want more information on, and everything around that. Anything to add before we wrap up tonight, DeAndrea, Scott, or Falita? We truly appreciate you giving your time. This is a wonderful way to kick off a new year, talking about budgeting, finances, getting excited about how we're going to make some changes this year. We are thrilled to be able to be part of this and are really, really excited about continuing to have this conversation.
Well, I just want to reiterate what you said about if people are interested in having a one-on-one conversation about their situation, to please reach out to us directly, because everybody's situation is different. I can see it just from the questions that people are asking. So it's a no obligation phone call. So feel free to call us, communicate, and if we can help you, great. Love to do it.
I ditto that on Scott.
Yes, Greater Atlanta Bills Credit is available to assist with any financial coaching needs, as well as providing access to additional resources and materials related to financial literacy or credit education.
Wonderful. Well, this has been such a fantastic way to kick off our program year. On behalf of the Atlanta Autism Consortium, a big thank you to all of our panelists tonight and to all of our attendees for giving your time to be here. I hope that we equipped you with some new knowledge, some questions to ask as you move forward in this conversation. And we truly appreciate all of you giving your time to be part of this program tonight. Be on the lookout for that email from us tomorrow morning. And in the meantime, if you need anything, always feel free to reach out. We appreciate you, and we look forward to hopefully having a program in person very soon. Thank you so much. Have a wonderful night.